Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for June 27th of 2022. Please see our disclaimer for important information. Here's our high frequency data, courtesy of our friends up at First Trust. As you can see here on the right-hand column in the weekly change, we actually have seen some positive trends in hotel occupancy, open table data for up 14.3% week over week, and over the last month up 11%. So pretty strong indicators there. TSA checkpoint data, we know that there are a lot more travelers out there, both on the business and the recreational side. Those numbers are positive. Supply of motor gasoline down slightly. Haven't really seen a tremendous amount of supply or demand destruction due to high gasoline prices. You do see rail car traffic and steel production down a little bit. As we'll get into this a little later, we definitely see manufacturing slowing down a little bit, and definitely see some indicators just overall that high inflation is kind of taking its toll just a little bit on certain areas of the economy. It's a tweet from Charlie Bolello, and I thought that was interesting because he went back and showed us going back essentially 10 years, and median price of a new home, $233,000. Now it's almost $450,000, and then mortgage rates had been quite low. June 2012, 3.66. Now pushing 6, frankly. And then you see down payments there, and the monthly mortgage payments up 147%, and that. Again, this is looking over the last 10 years, but I can tell you that the change and the rate of change just in the last 6 months alone has been phenomenal. Here is some of that manufacturing data that I told you about. And as you can see here, when you look at the overall manufacturing purchasing managers index, the actual data came in below expectations. It is slowing by virtue of what inflation is doing to our economy. Honestly, it was expected given the snapback that we had following the massive drawdown in manufacturing. And so it's frankly a lot closer to a more normalized level than anything else, although you can see in the lower left-hand part of the slide that output has actually slipped slightly negative. And so I think that shows you the contraction given the high inflation rates that we're seeing. New orders, again, also negative. This is showing contraction and a bit of a pullback in terms of our economic growth, at least on the manufacturing side. Here's a quick look at the services PMI, which is also slowing. Not too surprisingly, incoming new business on the right-hand side is now firmly in negative territory. Again, this is not something that we should fear. This is something that is typical with high inflationary periods. You do have demand destruction, and I think it's worth reminding here that this is what the Fed is trying to achieve with rate increases, although I'd argue that they'd have much more success at this, much more rapid success, if they focused on the money supply instead of just interest rates. But regardless, it's accomplishing the goal of slowing the economy down. And again, if you spend too much time in the contractionary territory, it does lead to a recession. But you can see, on this data, and certainly the manufacturing data that preceded it in the prior slide, we were at very high levels, unusually high levels. And so, to have some kind of mean reversion is actually not necessarily a bad thing. So in an effort to, find that silver lining amidst recently negative and adverse data points, one can point to the fact that we are mean reverting in a period of high inflation that is actually resulting in some demand destruction, which is what we want to help mitigate the price growth that we're seeing. Interesting in that when you talk about wage inflation, availability of workers, you do have more people re-entering the labor force, and labor markets are indeed pretty strong right now, although hiring intentions seem to suggest that labor is going to soften up a little bit. Maybe even we have a couple of upticks in the unemployment rate, which again would be very consistent with what the Fed is not necessarily trying to achieve, higher unemployment. They just want stable employment amid stable prices. And I think in being aggressive and the strong rhetoric that they're putting out there with regard to interest rates, it's ultimately going to have an impact on hiring decisions that are made at the corporate level amidst what is clearly some slowing in various parts of our economy. Now, this is one thing I thought was really interesting from Bureau of Labor Statistics, and that is the working age foreign-born population. And so when you think about, and several years ago that we had immigration restrictions and limitations on visas, and then we had the pandemic, which slowed or maybe essentially stopped cross-border traffic for quite some time. That we actually are at a deficit of working age foreign workers, foreign-born workers, I should say, and so that has taken some supply of labor out of our market and also contributed to higher wage inflation. Now, this is from the CBO. Again, more labor-related impacts on our economy, and you can see here going back into these long expansion periods, the impact of labor, which is kind of in this dark amber-ish section here. You can see the impact of labor on average annual growth in the economy has become less over time, and so productivity has become much more important, as you might maybe expect, perhaps with the dawn of the technological age, and you're getting in, Web 3.0 and all of these advanced technologies. This could certainly, explains part of the trend, but we've had productivity for a long time, as you can see here in the light orange colored bars. But the issue is that productivity is going to play a much, much bigger role, clearly, in terms of our ability to continue to expand our economy in the years and decades ahead. Now, here's a chart of container freight rates, and as you can see here, one of the things that we've been monitoring are supply chain choke points, and so obviously they were very tight. Lead times were very long. We've been unable, into many respects, of getting more container ships that are manufactured abroad because of trade restrictions, so on and so forth. But the good news is here that, again, some of this is due to the economic situation, that we have slowing growth, and so that is causing some of these supply chain issues to kind of work themselves out to some degree. And so you can see here that freight rates for 40-pound containers has actually gone down much more consistently than it's gone up lately. In fact, there's only a handful of data points in the last, call it the last year here, where freight rates have actually gone up. Here's a quick look at inflation on a couple of measures. On the blue line, we've got basically the five-year, what we call a 5+5 rate. And this is just the expected 5-year inflation rate looking out 5 years from now. And so that number has been fairly consistent, maybe a slight uptick there, about 2.69. This is essentially a long-term, call it a 10-year inflation outlook, and it's still 2.5 to 2.7, and maybe the lowest it's been really, and you look at over the last year, has been about 2.5, 2.4, and so it's up slightly. And that amber line you see is essentially the break-even, looking at a Treasury inflation protected security, and so that's a lot more volatile, right, than this forward outlook is. And so obviously we've had that spike, but very interestingly, the break-even rate as judged by the 5-year Treasury inflation protected Treasury security has actually come down quite a bit. So here's retail sales, and what this is showing is the degree to which retail sales have contributed to consumer spending. And you can see here that, when you get back in the mid-90s, it was a little bit higher than it is now, maybe about 49–50% of total consumer spending, and so that's dropped very consistently as the mix of consumer spending has changed, and that's obviously perked up quite a bit during the pandemic when we have had a rise in people shopping on Amazon to deliver at home, goods purchases, so on and so forth. So it certainly has become much more relevant as a percent of consumer spending, which we know is about 2/3 to 70% of the overall economy. So this is an important chart in the sense that we need to have it stay a little bit consistent, even though we're off these interim peaks. We need to have it stay somewhat consistent to maintain our economic stability. We'll just talk about the residential real estate market here for a little bit. So our 30-year fixed rate mortgages, as we mentioned a little bit before in that 10-year look by Charlie Bolello, we're about 5.8. So we're not quite at 6, but you've got to go back to 2008 before the global financial crisis to get to areas where we are now. Now, I would argue that mortgage rates based on very, very, very easy credit over that long expansion were probably artificially low. And rates started to move up as the Fed started to raise rates again in the middle part of the last decade, but obviously everything kind of fell off the table during COVID, but we're actually falling prior to that. And we know that the economy was beginning to look a little top heavy even in the fourth quarter of 2019. So, but we are seeing the spike. Obviously it's affecting affordability, but when you look at it from a longer term trend line, going back before the global financial crisis, these are levels that are actually somewhat consistent with the experience. So quick tweet here from Liz Ann Saunders of Charles Schwab. New home sales were up almost 11% in the May reading, which is the most reading we have. Obviously don't have June yet. And then that was a bit of a reversal from what we saw in the prior month. And so months of supply, again, evidencing a strong market because it moved down, and the median home prices are still up 15%. But when you look at where we are in the cost of home construction, we look at building permits for residential. I think there's an argument to be made that we see some slowing in this, and perhaps the home price slowing is where we're going to see it perhaps manifest the most. Even in our own local backyard here in Cedar Park, we see a lot of listings begin to come down and being revised down. And we have a slide coming up which will highlight that. And so we've got two slides. This is the existing home sales median price change year over year. And as I mentioned, we were well above 20% in year over year price changes, and that has moderated down. So, in this particular reading, this particular data series, we're closer to about 15%. And I guess, the crux of what I was saying in the last slide is that it wouldn't surprise me to see this move down below 10, closer to 0, before it's all said and done. Again, that's not suggesting that we're going to have outright price declines, because we have gone through 10 years of under construction in residential real estate. And we do know that the first-time home buyer is really struggling to find something affordable right now, but they are certainly motivated buyers. And so that demand is not going to go away. And I think that does provide a bit of an underpinning to the price environment. Here's a chart from Redfin, which shows a very distinctive spike, and you can see how seasonal this is. But where we are now is very unusual in the sense that we've had this is a 4-week rolling average percentage share of homes for sale that have had price drops, and so we've seen, again, it's not a huge number, but it is rising, and it showed a relatively strong peak here, about 5.6. So it just goes to emphasize the point that, I think we have seen the peak in home sale price increases. I think the price increases moderate from here, but don't necessarily go negative. And this is a chart that shows basically the price to rent ratio. And so we know that rents typically take about 9 to 12 months to catch up with prices, and that has absolutely happened. But again, what we have seen evidenced in the prior charts here is that we've had really outsized home price appreciation, and particularly that year-over-year chart that we showed you that had the spike of above 20% and existing home sale prices, and that's just artificially high. That's not sustainable. But we're still at a point now where rents have not yet caught up, and so the price to rent ratio is still at essentially an all-time high here. And so the cost to rent on a relative basis to home ownership is still attractive, but again, everything is relative. So both are moving higher, but we still see prices on owned residences continue to far outpace rentals. And here is a chart plotting crude prices against gasoline prices. And so, we have had actually, and I'd say this across the entire commodity basket, with the rally in the equity markets last week, which were up roughly 5.5–6% last week, we saw a corresponding decline in commodity prices. And in particular, we saw a drop in crude prices, which I think there are a lot of folks that are eagerly anticipating the potential for having a moderation in gasoline prices at the pump. Like we haven't seen that yet, and it does take time to filter through. We have awfully tight refining capacity right now. But we have seen a decline in crude down from roughly about $120 a barrel down to about $109, which in a week's time is actually a somewhat meaningful drop. But as you can see here, over the year to date, we've certainly had a lot of volatility in these prices. So, I think there is speculation that we'll see a gasoline price drop here in the next week or two. Here's a chart from Fidelity, which shows us in some great spaghetti detail here, bear market trends and where the market could potentially go in terms of monthly. This is monthly data after entering a bear market, technically, and so you can see the spaghetti chart. There is a general preponderance of the data moving higher, and I think that's confirmed with really the most recent several of these bear markets that we've seen. Now it does trend lower for a period of time, and as you can see in this chart, we've had probably a much stronger decline than average in our equity market in 22 than we've seen in other bear markets, meaning that in these other bear markets we've seen it traditionally take a little bit longer to reach the trough, and I think some people are beginning to wonder, have we seen the worst of the degradation in our market? Have we seen the worst in the degradation of our price to earnings ratio or valuations in the market? And maybe we have, maybe we haven't. I'd say that there's still a risk of additional downside. Generally speaking, bear market, peak to trough is maybe 30% before the market rallies. But you can see here in a lot of these data points where the market has witnessed its trough and then is actually kind of rebounded. Not in every year, but certainly in many years. Now here's a quick look at S&P 500 earnings, and this shows you the trend, analyst consensus estimates on really kind of a weekly change from year to year, looking at the forward year. And so that's why it looks a little bit awkward here. And you can see for 2021, back in 2019 when analysts began forecasting 2021, that those estimates in that green line moved generally higher. Everyone was optimistic when they started off in 29 estimating that, and things kind of pulled back in 2020, but then when we recovered, the estimates shot through the roof, and there was a lot of high expectations for 2021, which actually very much manifested themselves. Now, Towards the right side of this, you see the estimate trends for 2022 in the red, which, we started seeing those back in 2020. Of course, they were high, and then as we've entered, 2021, the estimates were moderating a little bit. So, and then 2023 now, these estimates are coming out as well. And so what we're seeing is pretty consistently right around the 9 to 11% range for both years. 2022, obviously the near year, we've got, 1 quarter worth of data in. We're going to hear from all these publicly traded firms here over the coming weeks after the close of the calendar quarter here in just a couple of days. But right now, estimates are trending about 10% for both years, and I think that's really, the crux of the issue with the equity markets is if earnings can hold up, then multiples have gotten a lot cheaper, kind of closer to fair value, if you will, even though they're not outright cheap. But of course, all bets are off if earnings erode from here. And traditionally speaking, earnings typically get a little bit stronger as you get closer to the reporting periods. Now here's a quick look at profit margins. And so this profit margins and earnings are definitely related, obviously, because this is the ratio of profits that you have left after your operating expenses. And as you can see here, profit margins over time in these various little spaghetti strands here, have moved higher and as they've moved towards the right. And that means that profit margins over the last 13, 14 years have continued to move higher. And so in 2021, profit margin estimates, in the green line again, during the pandemic, obviously everything fell through the floor. But then it recovered again as we emerged from the lockdowns and whatnot. And so 2022 started off at a high level in the red there. And as you can see here, that margins are rolling over. Estimates for margins as we finish the year are looking to roll over a little bit. And I think that trend probably continues somewhat. I could pick up a little bit of steam. You can see in the blue there that 2023 is starting off at an exceptionally high level and coming off that. I actually do think that will come down a bit more. The expectations, I think, in many respects are a little too high, which in turn I think makes some of these earnings estimates that we just saw on the last slide a little bit too high. Now, if you told me that instead of 10 to 11% earnings growth, which we were talking about in the last slide, that we're talking about something like closer to 5 to 7%, that would actually be a lot closer to the long-term average annual profit growth of roughly about 6 to 7%. And then if you correlate that back to annual returns expected in the S&P 500, you get to roughly 10% or a little bit more if you add dividends to that. Call it 6.5 to 7%. You add about a 2 to 3% dividend yield, and that gets you pretty close to 10% annual estimated average earnings. But here, clearly, I think profit margins looking ahead at the end of this year and next year are likely to come down. Inflation expectations. We hinted this in the five-year a few charts ago, and this is confirmed here with the 5-year tips break-even rate. So again, you've already seen this line, you've already seen this chart, and all I did here was to plot it against the container rates to show you that there is a relationship here. So inflation expectations and container shipping rates and freight rates and logistics costs and things like that, they're all tied in with each other. And so obviously supply constraints and choke points in the shipping area have contributed to inflation. And so as demand kind of rolls off a little bit and some of these supply chain issues kind of work themselves out a little bit, then you actually do have a corresponding decrease in inflation expectations. And I think this is a trend that's going to pick up steam and at some point, is going to begin the conversation of, well, how much work does the Fed have to do if inflation expectations and realized and observed inflation begins to move lower. So Fidelity does a really good job of looking at the historical backdrop. And so, what they've done here is they've gone back to 1994, which was the precipice of a rate tightening cycle, for those of you old enough to remember that. And then they bring it to the present, show you 2022. And again, we had the pandemic, so that makes things a little funky here. But back in 1994, obviously you had the PE ratio, as we were in a very adverse market situation, and we were in a rate tightening cycle as well. You can see the PE ratio came down, as did the 2-year yield. But then you had a point of capitulation, and at that point the market was priced at about 15.5 times forward earnings, and the 2-year yield was actually over almost 8%, and that was a long time ago. Just put it that way. I actually do remember those rates being a lot higher back then, and certainly back in the 80s as well. But fast forward to 2022, and you can see that the same trend is happening here. And so we now are back about 15.5 times earnings on the next 12 months, or basically the forward PE ratio for the S&P 500. And we have 2-year yields that have both gone up and have come back down to about 3.2%. And then you can see the below in the shaded bars is the 2 to 10-year yield curve, which again in 1994 with the rate increases, exhibited a lot of flattening, and so you saw a pretty flat curve. And I think we are going to see that now, because as we have seen already in today's chart pack, that long-term inflation expectations are really well anchored at like 2.6, 2.5. And so as short-term rates move higher, inflation expectations pushing them higher, you can see a flattening in the curve. So the takeaway from this chart is that, we did see at this point of capitulation in 1994, earnings multiples begin to expand again. And I think, we're probably not at that point yet. And this is actually the article, or the point that Fidelity is making with this chart, is that we may not be at that final point of capitulation where multiples begin to expand again. But I'd say we're a lot closer to that than we are the largesse of the slide that we've seen to date. So here's a technical representation of the market, and so and then this is a stochastic indicator, and I'm not a big technical guy, but technicals do tell an interesting story. And so what this says is we're probably as oversold as we have been in a long time, or at least we were when this chart was compiled data before we had the real run-up in prices. So we are, I believe this is Tuesday, so Wednesday through Friday were obviously exceptionally strong days, ending on a high note for the week. So at least we were at extremely oversold levels by this particular indicator, but we've been able to bid up the market a little bit since then. And here's a chart that shows you, basically the potential of large years and having corrections. And the story that you take away from all of these different data points going back to essentially 1932 is that when you have big years, you tend to consolidate. And this may be, well, a consolidation year, because if you look at this chart and you go down to the very bottom, you can see all these different years, and then you can see what the prior 2-year return was. You can see in a lot of these years the S&P 500 was negative, and that shows that the market was kind of consolidating after a 2-year run of pretty exceptional performance. And this is in particular looking at years in which the market was up double digits, and in some cases, like the last 2 years was up 52%. And so we don't know what the year is going to end up like, but if you go back to 2018, the prior 2 years, 2016, 2017, were up 36.4, and the S&P was down that year about 4.4%, but in the next 2 years it was up about 55%. So the point here is that you can have 2-year returns that are really outstanding, that lead to a negative year, that oftentimes lead to a couple of years after that of relative outperformance. So as we look at the market, we spend a lot of time on the S&P 500, but it should not be lost on anybody that the Russell 2000 has taken a drubbing, and you can see that just in terms of the black line here, which is the index. But if you look at multiples, you look at valuations, I mean, the Russell 2000 price to earnings ratio is down around 10 times, and we've talked about the S&P 500 being closer to 15.5, which is much closer to its long-term average. And it's come down quite a bit, but the multiple here in the Russell 2000 has come down much more dramatically, and there's a lot of embedded value that just needs a catalyst here. So I thought this was interesting. This is making a supposition from Trahan Macro. In the upwards sloping dark line there, you've got forward earnings for the S&P 500, and this was, I believe, this may be just a tad dated, but it kind of shows the story here. You've got earnings that are going up consistently, and these are aggregate earnings for the S&P 500. And at the same time, you've got, from January, you've got multiples that are coming down. Now, I do think the dark line here is decelerating. You're beginning to see those earnings slow up a little bit. So, again, I think they're positive still, but they're just not moving up at the same rate of speed. But you have seen forward price to earnings ratios come down quite a bit. Again, about 15.5% for the S&P 500, and as we just saw, about 10 times for the Russell 2000, which includes a lot of the small cap stocks. Here's maybe one of the more interesting slides, to me at least, is that when you have turbulence in the equity sector, you tend to see tremendous flows into bonds, and this has been a consistent theme that I've shared with investors and clients for the bulk of the spring and into the summer now, is that this year equities have been struggling, but so have bonds too, and typically you see a lot of flows into the bond market when equities struggle, and then obviously that's the usual scenarios that you see high demand, which drives prices higher, which drives yields lower, or at least keeps yields from moving too much higher as your investors are fleeing stocks to try to find a safe haven. But basically we're coming off in a bond market where rates and yields have been exceptionally low because interest rates have been low for a long time. And so when people started worrying about higher interest rates, and you're at the cusp of a rate tightening cycle, there was a lot of panic. And so you saw basically, yields move higher fairly quickly. And that means that there was a corresponding liquidation of bonds. And so, you can see that very clearly here, that you've got fund flows on a 4-week moving average, decidedly negative, which is extremely rare. You look here over this multiple years range, and tends to not happen very much. It happened back in 2018 when we had a very weak equity market, and obviously it happened during the pandemic. But you don't see it consistently for very long. But we have this spring, and so it's just contributed to this this awkward environment where both bonds and stocks are performing negatively. Well, a quick check-in on some commodities, and I think this is important here, for a lot of reasons. And but I don't think it's symptomatic of a longer trend, because I do think that commodities are in for a fairly decent cycle, an uptick here. So we've got the agricultural sub-index, which includes corn, cotton, a lot of different things, soybeans, a lot of different things. So you can see the ag complex coming down off its peak. Again, it's well above long-term trend lines, so let's make that clear. It's just off its peak, which is good, and this has actually corresponded here over the last week with the higher equity prices. And so I think we'll find equilibrium in commodities, lower than where it is now, but much higher than it has been historically. You can also see that in the industrial metals. You see copper coming off its peak, aluminum coming off its peak. Here is the American Association of Individual Investors sentiment readings, and you can see here that the 8-week moving average, which is on the bottom, which is a little less noisy than the aggregate readings, is at a level we just haven't seen this since the global financial crisis. I mean, investors by and large are extremely bearish, which, if you're a long-term investor, you see that as a contrarian indicator. And again, as we were looking a few charts ago and we're talking about, is this the point of capitulation? Maybe not yet, but I think we're getting close. And generally, these high levels of investor bearish sentiments correspond with inflection points in the equity markets. And you generally don't see this persist for too long before you begin to see a turnaround. And you want to flush out, as Liz Ann Saunders at Schwab calls it, you need to flush out these bears, get them to that final point of capitulation where people kind of then can begin to jump in. Forward earnings yield is here. So we see the 10-year Treasury minus the 10-year yield. So this is basically the equity risk premium. And so you look at that on the left, you look at it on the right, it shows you that equity risk premium in the light colored yellow there, and then you see the Purchasing Managers Index year over year, which is the darker one. And so usually when you have your PMI fall like it has, you see that risk premium go up. And so if you go back over to the left, generally speaking, you would expect the earnings or the equity risk premium to be higher than it is now. And that's why I say we might not be at that final point of inflection in the market. We are close though, but you would expect the risk premium to move a little bit higher. And talking about earnings revisions, you can see here that when you look at the change here heading into the second quarter, that we have seen some downward revisions. Now, I think they're still likely to come down a little bit. Again, going to our little spaghetti chart some charts ago, but I think we're going to see a few more revisions. But again, I think it's really healthy going into a reporting quarter when you're kind of setting your expectations bar lower, which will help some companies actually beat expectations. So here's the average volatility index. And so when I tell people we've had more volatility this year, I actually mean it. And here it is in graphic representation. So, some years we've had a lot of volatility, back in the dot-com era in the late 90s and 2000. Obviously in 2000 we had a tech bubble crash and that lasted through 2002. You can see those years were exceptionally volatile, and then volatility dropped off, and then we had the global financial crisis, and it really spiked up and stayed high in 2009 as the equity markets rebounded. But and then volatility gradually has kind of wound down a little bit over the last number of years, and then spiked during COVID, was off last year. Now it's perked up again. So we have had higher volatility this year in our equity markets. And as we've seen, corporate yield spreads have moved higher for credit. Credit spreads, I should call it, have moved higher. And you can see that on the right-hand side, it typically corresponds with rate increases. So as we've seen the Fed increase rates, it's only natural to see credit spreads widen out a little bit. And what does that mean? That means that, even though you have increases in Treasury yields, so U.S. Treasuries yields are moving higher at any given maturity, call it 5 years, you're seeing a higher rate of increase in yields for corporate credit, especially corporate credit that is at lower credit tiers. And so I expect that, it's natural to assume that's why high yield has been a little bit of a troublesome spot this year, and we've kind of de-emphasized it a little bit. But that is very consistent with what happens in a rate tightening cycle. Well, that's all we have for today. Hope you've enjoyed the chart pack and look forward to talking to you again soon. Have a great week. Bye-bye.